How do you solve a housing crisis when even the solutions seem to falter? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. Today, we're diving into a pressing issue that's capturing the attention of real estate developers and investors across Canada. According to a recent article by Tim Kaladze, published on August 16, 2025, in the Globe and Mail, rental apartment construction, once seen as a potential fix for Canada's housing crisis, is facing significant challenges. Developers are struggling, and the effects are spreading across the sector. 7 years ago, RioCan Real Estate Investment Trust, a prominent name in Canadian real estate, embarked on a mission to diversify its portfolio by developing rental apartment towers. This move was in response to the growing e-commerce trend that had made investors wary of traditional retail investments. RioCan's new division, Living, aimed to capitalize on Canada's worsening housing shortage and the government's plans to welcome more immigrants. The plan was to build luxury rental apartments, complete with high-end amenities like cold storage for deliveries, in hopes of attracting tenants willing to pay premium rents. However, by May of this year, RioCan announced its decision to scale back its residential development ambitions, opting to sell its existing buildings and exit the sector. The company cited the need for a different funding strategy, relying more heavily on outside investors for future projects. The challenges faced by RioCan reflect a broader industry trend. Institutional investors, essential for funding these large-scale projects, are deterred by the low returns, which have dropped to as low as 4.5% annually. This is a significant concern given the rising interest rates since March 2022, which have made mortgages more expensive and alternative investments more appealing. Despite the continued demand for housing, especially in populous areas like Toronto and Vancouver, the financial viability of new rental developments is under threat. Falling rents, particularly in these major cities, are not meeting financial projections, making it difficult for developers to secure necessary funding. The market is also experiencing a decline in international students, a key demographic for rental properties, further complicating the situation. There is a silver lining, though. Costs for land and construction are beginning to decline, offering some relief to developers. However, development charges imposed by municipalities remain high, posing a persistent challenge. These charges are a crucial revenue source for cities, offsetting financial burdens passed down from higher levels of government. In the face of these obstacles, some developers remain optimistic. For instance, Toronto-based Starlight Investments recently broke ground on a new project in Victoria, signaling that new rental development is not entirely stalled. However, the slowdown in Toronto and Vancouver, where the housing crisis is most severe, could lead to a more acute shortage in the coming years. The situation is reminiscent of other sectors in Canada, such as the mining industry, where the demand for critical resources is high, yet securing private financing remains a challenge. It's a complex issue that requires strategic thinking and innovative solutions to overcome. According to a recent analysis by Redfin, the pace of multifamily housing permits has declined from the highs experienced during the COVID-19 pandemic. This data, sourced from the United States Census Bureau, reveals that developers secured an average of 12.8 permits for buildings with at least 5 units per 10,000 people from July 2024 through June 2025. This figure represents a 23.1% decrease from the 16.7 unit average during the pandemic-era building boom from 2020 to 2023, and it is 1.1% below the 13-unit average from 2014 to 2020. The surge in multifamily housing development during the pandemic was largely driven by the trend of Americans relocating under remote work policies, particularly to high-demand Sunbelt states such as Texas and Florida. Builders ramped up activity in response, reaching a 50-year high in multifamily completions in 2024. This increased supply led to a drop in rents as landlords competed for tenants. However, the landscape has changed significantly. Falling rents and high borrowing costs have since slowed construction activity. While rents have been flat or falling for most of the past 2 years, the median asking rent did see a slight increase of 1.7% in July from a year earlier. Redfin senior economist Shaharyar Bukhari noted that asking rents might now be ticking up because the pool of available new apartments is shrinking while demand for rentals grows. As a result, renters could see perks like free parking start to disappear if landlords gain more leverage. Despite the general slowdown, the Sunbelt region continues to outpace others in new housing development, although many cities there have also seen a reduction in permitting since the pandemic. The most significant declines in permitting have occurred in the West. For instance, Northport, Florida, issued permits for 65 multifamily units per 10,000 residents in the past year, the highest among the 78 United States metro areas analyzed by Redfin with populations over 750,000. Austin, Texas, ranked second, followed closely by Cape Coral, Florida. At the other end of the spectrum, Stockton, California recorded no multifamily permits in the past year, showcasing the stark contrast between regions. Overall, 59% of the metro areas studied experienced a decrease in multifamily permits compared to the pandemic period. Stockton's permitting fell by 100%, followed by cities like San Jose, California, and Colorado Springs, Colorado. In a move that could reshape the landscape of Stamford, Connecticut, the State Department of Transportation has opened a request for proposals for multifamily housing development at the Stamford train station. This initiative is part of a broader plan to redevelop the Stuart B. McKinney Stamford Transportation Center, aiming to transform it into a vibrant transit hub. The deadline for submissions is December 5th, and the state agency is seeking projects that are transit-oriented and mixed use. This means incorporating spaces for retail, commercial, office, hotel, or civic use within an 11-acre area around the station. The goal is to replace, relocate, and repurpose station facilities, including platforms, to accommodate long-term growth. The Department of Transportation has crafted a master plan to revamp the station. First developed in early 2024, following renovations in the early 2000s. The department plans to select up to 2 development teams and execute pre-development agreements by February 27, 2026. Commissioner Garrett Eucaliddo highlighted the significance of this project, describing it as a once-in-a-generation opportunity to create a transit hub that serves Stamford's growth and the evolving needs of travelers. This redevelopment is expected to deliver new housing, enhance transit amenities, and commercial and retail spaces that will benefit both residents and visitors for decades to come. For developers interested in responding to the request for proposals, full details and submission requirements can be reviewed on the State Department of Administrative Services CT Source bid board. The project solicitation number is STCTOD 81425. This initiative reflects a growing trend towards transit-oriented development, which is gaining traction across North America. By integrating residential and commercial spaces with public transit, cities can boost economic growth, reduce traffic congestion, and create more livable communities. It's a promising approach that aligns with the needs of modern urban living, and Stamford's plans could set a benchmark for similar projects in the future. As we wrap up today's episode, it's clear that the challenges facing the multifamily real estate sector are complex, but with strategic planning and innovative solutions, there's potential for significant progress. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.